Hello. In this video, we'll be going through the second half of how to account for an equity investment using the equity method. So if you haven't looked at part one of this video, then I highly suggest you do, because when I go through this video, I'm assuming that you have already looked at the first one and are familiar with the examples we're going to go through. But just as a quick overview, when we use the equity method to account for an investment in equity, which means that we buy stock, one company buys stock in another company. It does mean that usually the company that acquired stock has significant influence over the company that they acquired stock in. And usually that means that they acquired anywhere between 20 and 50% of that company's voting stock. So we will continue with our example of United Intergroup that purchased 30% of Arhant Inc.'s common stock for $1.5 million cash in the beginning of 2027. So we accounted for how to account for the actual purchase of the investment, which would be the fair value times its share, which is 30%. And we created an investment account, increasing investment in equity for $1.5 million, which is 30% of the 5 right there. And we also learned how to account for United Group's proportionate share of Arhant's net income and their dividends paid. The next thing that we're going to do in this video is there might be some other adjustments that need to be made under the equity method. First thing we have to look at is to see if there is any purchased goodwill. And goodwill is when a company acquires another company or a portion of another company and pays more than the fair value. And that fair value is in that difference is inherent in more than just the fair value of the assets within the company. So in this situation, right, United, we paid $5 million for 30% of Arhant. There are these identifiable net assets, which means because goodwill is not identifiable, it's intangible. It's just created via the purchase of the stock. But we're going to look at what we call as the identifiable net assets using the book value versus the fair value. The company Arhant has $1 million of buildings, $500,000 of land, and $600,000 of other assets for total book value of these assets of 2.1. When we look at the fair value of those assets, it's 3.6. So we acquired these assets right here that have a fair value of 3.6, but we paid $5 million for it, which means that $1.4 million, the additional $1.4 million is considered to be goodwill. And we'll take 30% of that equals we acquired $420,000 of goodwill. We're not going to do anything with that goodwill. Goodwill is not depreciable. It is not amortizable. We're not going to amortize that goodwill. Goodwill is looked at year end or at the end of the period to see if an impairment exists, at which time it will be written down. But that's not the scope of this recording. What we're going to look at is we know that the difference between the 5 million and 3.6 equals goodwill. We're going to look at the difference between the identifiable net assets, book value versus fair value. I'm going to erase this just so it doesn't get super messy, which you guys know is quite frequent with my videos. So we have 2.1 versus 3.6, and everything is at 30%. So when you look at the difference between 3.6 minus 2.1, it equals 1.5 times 30% is 450,000. So we have a $450,000 difference for our share of Arhant between the book value of the assets versus the fair value of the assets. And what we have to do when an investor buys stock in another company using the equity method and pays more than the book value of the underlying net assets acquired, we have to approximate, the way we account for it is we have to approximate the effects as if we were consolidating the two entities without actually consolidating them. And the way we do that is we're going to adjust our investment account in this company. So United is going to adjust its investment account in Argent and investment revenue as if we're consolidating them. And what we're going to look at, we're going to look at the assets that were written up, that we acquired more than fair value, to see what we need to do with each one of them, if we need to depreciate them more or have a higher expense on our income statement. And we're going to go through that. So we're going to look at, let's look at land first. So the book value of the land that we acquired was $500,000. The fair value is $1 million. But land is never depreciated, so we don't need to do anything with land. That's kind of an A. Other identifiable assets in this example are the book value, and the fair value is the same. So we're not going to do anything with that as well for right now. Let's look at the buildings. The building, the book value is $1 million versus fair value is $2 million. And what happens is, let me erase this once again. When we look at Argent's net income that they had for 2027, it was $500,000. Included in that net income was depreciation expense for this $1 million building. Now, that depreciation expense was based on this book value. What we want to do is calculate the depreciation expense as if the building had actually been written up to its fair value of $2 million. So let's just say this building has a 10-year life, which means that in 2027, the company would have taken $1 million divided by 10 years, so they would have expensed $100,000 versus where if we were to true it up to fair value, it would have been $200,000 of depreciation, right? So we're going to look at the depreciation that we would have calculated, right, using the fair value versus the depreciation that was actually depreciated using the book value. And the difference is we would have gotten an additional $100,000 of depreciation expense. However, we only own 30%. So we would have had additional depreciation expense of $30,000 had it been depreciated using the fair value. Additional depreciation expense, so here's additional depreciation expense, would have meant a lower net income, right, by 30,000 because depreciation will reduce your net income. Lower net income would have therefore, so lower net income would mean that we would have a decrease in our investment by that amount and a decrease in our investment revenue in that account. And so we need to record that difference. And the way we're going to do that is we're going to debit investment revenue by 30 and credit our investment in equity affiliate by 30. So this will affect our income statement and this will affect our balance sheet. So that's kind of additional, this adjustment for additional depreciation when you acquire an asset, that a depreciable asset, where the fair value is more than the book value. Let's talk about this net other identifiable assets, which are the same for this example. Let's just say this has to do with inventory. And we acquired for 600, but the fair value of that inventory is actually 800,000. That means that there's cost of goods sold in the 500,000 using our inventory of 600,000, which is fine because that's what this is our ending inventory, so that's what remains to be expensed in the future. So assuming we sell all of our inventory at least once a year, which is typical for most companies, in the following year, in 2028, we would have additional $200,000 cost of goods sold had our inventory been written up when it was acquired. And so therefore, the 200,000 times our share of 30% is 60,000, and we would book this entry in 2028 using $60,000. But once that's done one time, then you don't need to, it's not a recurring entry like depreciation, because our inventory will just, that inventory will sell the following year, and then we'll get to be on the same cycle as needed. So this is just talking about the inventory. So let's talk about the actual reporting in our investment account. We debited the investment account for $1.5 million. Here's our share of the income, right? That was the 500,000 times 30%. We increased our share, and the dividends was the 250,000 of dividends that they paid times 30%, where we reduced our investment for those dividends paid. Plus now we have additional depreciation expense that we adjusted our investment in, and it was a credit to investment and debit investment revenue. So our net balance in our investment account is $1,545 million. When we go to sell our investment, we have to see what the balance is in our investment account, which at 12/31 was the 1,545. And let's assume that we sell the stock for 1,446 on January 1, 2028. So we receive cash for the 1,446. We have to remove our investment equity affiliate by crediting for the balance on our balance sheet. And then the difference is applied, whether it's a gain or loss, which in this situation, it is a loss on investment, and that is for 99,000, and that goes through our net income. So we actually recognize that loss, and it will reduce our net income. When we say our, this is talking about United's books. We have sold our investment in Argent. Just really quickly, I want to cover this example assumed that we acquired stock in Argent on January 2nd, but typically that's not the case, right? Companies make investments in other companies throughout the year. And when that happens, we just have to pro rata any sort of income and dividends and depreciation adjustments or cost of sales adjustments to reflect the date that we acquired that asset. So if United purchased 30% of Argent on October 1, they still would have paid the $1.5 million. So we still increased our investment by $1.5 million. But now when you're looking at Argent's income, right, their income was $500,000. That was for the full year. That was from 1/1 to 12/31. And we get 30% of that, which is $150,000. Well, we would recognize $150,000 of that income if we acquired that asset, those stock, on January 1 or January 2nd. But if we acquired it on October 1, we're only owning that company for the months of October, November, and December. So only 3 months out of the year. So we would multiply it for the pro rata share. And we would do the same with the dividends and the depreciation expense. We would take our share, so you'd have to multiply by 30% and then prorate it for the amount of days that we own it during that year. So in that situation, our net investment at 12/31/27 would be $1,511,250 if we had acquired that stock on October 1. Let's talk about impairment of the equity method. So we're talking about the investment account on our balance sheet. If we see that the investment's fair value has declined below its carrying value, and we would think it's viewed other than temporary. So basically, if we think this is a permanent decline, right, in the fair value of the investment below its current carrying value, then we would recognize an impairment loss in net income, which means our income statement is going to go down, right? Our net income will actually go down. It will be a recognized loss, and we reduce it to the fair value. And then we continue moving on with our equity method as usual. Oftentimes, when we own stock in a company, we might buy more shares and we might sell shares. So sometimes we can go from a change from the equity method to the fair value method, or if some sort of condition changes where our influence level changes, right? But let's just say this is just purely based on buying and selling stock. So if we owned 30% of the company and then we sold 20%, so now we only own 10%, then we're going to go from the equity method to the fair value method to account for that investment. In that situation, no adjustment is made to the carrying amount of the investment. Just the equity method is discontinued, and you're going to start accounting for the investment as it's accounted for fair value through net income from that point on. And the balance in the investment accounts as the starting point for the new method. So basically, whatever your balance is on that date, you just start accounting for it using the fair value. Now, what if a change happens from the fair value to the equity method? So let's just say we own 10%, but then we buy 20% of that company's stock. So now we own 30% and consider to have significant influence. We need to change it from the fair value method to the equity method. In that situation, the securities are marked to fair value, like on that date. Whatever your investment is, you true it up to the fair value, and you recognize any unrealized gain or loss through the income statement. You add the additional cost of the shares that you acquired to that investment balance, and then you're going to start accounting for it using the equity method, and you should have a disclosure note to describe that change.